While most investors sleep on silver, a handful of analysts are making predictions that sound absolutely insane. $41 per ounce. Conservative, they say. 100? Possible. But 200? Some are dead serious. Here's what they know that you don't. Major banks are quietly repositioning. China's export restrictions tightening by the week. And the COMEX? Well, let's just say the inventory numbers tell a story most refuse to believe. 3 different price targets, 3 vastly different scenarios, but only one of them accounts for what's really happening behind closed doors. Which prediction will prove correct? And more importantly, what does it mean for your wealth? Welcome to Currency Archive. If you've been in business long enough, you know that the most important financial moves happen in silence before the headlines arrive. Now, if you appreciate strategic economic analysis that respects your time and intelligence, I'd be honored if you'd subscribe to this channel. We don't chase trends here. We track the signals that matter. And I'm curious, where in the world are you watching this from today? Let me know in the comments below. Now, let's examine why 3 serious analysts are looking at the same silver market and seeing 3 completely different futures. When famous names start throwing out big silver numbers, it's never random. It happens at very specific moments in a market cycle. Right now is one of them. Robert Kiyosaki talking openly about triple-digit silver in 2026 is not happening in a vacuum. Neither are aggressive outlooks coming from analysts who were cautious just a year ago. This isn't just Robert Kiyosaki making noise. Major analysts and institutions are now forecasting silver for 2026, each with their own price targets and timeframes. The way silver is making headlines at the start of 2026 isn't coincidence, it's timing. By mid-January 2026, the silver market already knows what it accomplished last year. The breakout is old news. The shock is worn off. What hasn't settled yet is what that breakout actually means. That's why predictions are getting louder now, not earlier. Big forecasts don't usually appear at the beginning of a movie. They appear after a move forces everyone to recalibrate. Silver didn't just rise in 2025. It forced belief. A market that forces belief becomes dangerous. Because belief is sticky, and silver is not. The danger today isn't missing upside. It's assuming the path forward will look like the path behind. That's where people get hurt. Last year, silver was climbing out of neglect. This year, it's operating under a spotlight. That changes everything. When silver spent years trapped under old resistance, participation was selective. Now participation is broad. Retail investors are back. Institutions have adjusted their allocations. Public figures are comfortable attaching big numbers to the metal. Every one of those adds demand. Every one of those also adds fragility. This is the part most forecasts don't discuss. When a market breaks out after a decade of compression, it doesn't immediately become stable. It becomes sensitive. Silver right now is not weak. It is reactive. That reactivity is what makes bold predictions dangerous if misunderstood. A $100 or $200 price target sounds directional, but it says nothing about volatility, drawdowns, or timing. Silver doesn't move in smooth trends after explosive years. It moves in bursts, fast up, fast down, then sideways longer than people expect. This is why January feels different from December. In December, silver was still being talked about as an event. In January, it's being treated as a baseline. That transition is subtle, but critical. Once people accept a higher price as normal, they stop managing risk the same way. They assume dips are temporary. They assume patience solves everything. Silver punishes that assumption. After a 147% year, the market isn't asking whether silver deserves higher prices. That argument has already been won. The market is asking whether positioning has outrun balance. That's a structural question, not a narrative one. Supply deficits didn't magically resolve at the start of 2026. Industrial demand didn't slow down. Solar, electrification, advanced electronics, and data infrastructure are still pulling metal. Those forces matter, but they don't prevent volatility. This is where clarity must temper optimism. Silver's fundamentals can remain strong while price behavior becomes hostile. That's not a contradiction. That's how pressure markets behave. Think of silver like a system under load. As long as pressure increases gradually, it holds. When pressure rises too quickly, the system shakes. Last year added pressure from demand. This year adds pressure from expectations. Expectations are heavier than demand. They change behavior. When famous personalities predict big upside, they don't just influence belief, they influence positioning. More people step in, more leverage appears, more assumptions get priced in. That's when silver becomes unforgiving, not because it can't go higher, but because it won't carry everyone there comfortably. This is why the risk profile today is not the same as it was 12 months ago. Last year was about recognition. This year is about digestion. Recognition lifts price. Digestion tests holders. Silver is now in the testing phase. That doesn't mean forecasts are wrong. It means forecasts are incomplete. They describe a destination without acknowledging the terrain. And silver's terrain in early 2026 is uneven. Some participants are well capitalized. Some are stretched. Some entered late, convinced the move must continue immediately. Silver treats those groups very differently. This is why pullbacks feel sharper now, why rallies feel less stable, why price action can look contradictory. The market is not confused, it is sorting out who belongs in the trade and who doesn't. This is where many investors make the mistake of equating long-term belief with short-term exposure. They hear bullish forecasts and assume time will smooth volatility away. Silver does not smooth. It compresses, then releases. That behavior doesn't stop just because supply is tight. In fact, tight supply often amplifies it. When inventories are constrained and liquidity thins, price has less room to absorb shocks. Moves overshoot. Corrections sting. That's what early 2026 is revealing. The market is not deciding whether silver belongs higher over time. It is deciding how much excess must be cleared first. That excess lives in positioning, not in vaults. Once predictions start circulating, the natural instinct is to compare numbers. Who is bullish? Who is conservative? Who sounds confident? That's exactly what's happening now in silver. Banks, research houses, and analysts have updated their outlooks after 2025's breakout, not because they want attention, but because the old models no longer fit. Silver didn't behave the way it was supposed to. That forces recalibration. And look at the range of forecasts now being discussed for 2026. Some institutions still see silver in the 40s, others push towards 60 or 70. Independent analysts talk openly about triple digits. That spread is not noise, it's a signal. When forecasts cluster tightly, markets are stable. When forecasts scatter, uncertainty is rising. Silver is in the second category. This is where the warning becomes more specific. Institutional forecasts are not promises. They are scenarios. Each one assumes a different mix of conditions, different growth paths, different policy outcomes, different investor behavior. The problem is not that these forecasts exist. The problem is how they're interpreted. Most people treat them like destinations. Silver will go there. Markets don't work that way. Forecasts don't tell you how price behaves under stress. They don't tell you how silver reacts when positioning gets crowded. They don't tell you what happens when volatility spikes. And silver, more than most assets, is shaped by those things. The research makes one thing clear. Silver's fundamentals are not thin. Industrial demand is real. Supply constraints are persistent. Deficits are not theoretical. Solar alone now consumes more than a quarter of annual silver supply. Electric vehicles are increasing silver intensity per unit. Advanced electronics and AI infrastructure are pulling demand forward. That's not speculative demand. That's functional demand. But here's the warning. Most bullish narratives skip. Industrial demand is steady. Markets are not. Factories buy silver methodically. Traders don't. When silver prices surged in 2025, they didn't just reflect consumption. They reflected positioning. ETF flows reversed. Futures volumes surged. Retail participation expanded rapidly once key price levels broke. The participation does not disappear just because the calendar changes. It has to be absorbed. This is why silver enters 2026 in a different state than it entered 2025. Last year, silver was undervalued relative to its fundamentals. This year, silver is fully valued, and then some relative to expectations. That's a subtle but critical shift. When a market is undervalued, good news lifts it easily. When a market is fully valued, good news must exceed expectations just to hold price. That's where volatility comes from. This is also why some institutional forecasts remain cautious, even while acknowledging strong fundamentals. They're not denying demand. They're accounting for digestion. After a 147% move, silver doesn't need more buyers. It needs balance. Balance takes time. The analysis points to multi-year supply deficits continuing into 2026. That's supportive. But supply deficits don't prevent pullbacks. They shape recoveries. This is where many investors misread the signal. They see deficits and assume downside risk is limited. In silver, downside risk is rarely limited in the short term. Silver's market is smaller than gold's. Liquidity is thinner. Price reacts faster. That's why silver historically moves roughly 1.5 to 2 times as much as gold in either direction. That characteristic doesn't disappear in bull markets. It intensifies. So when forecasts move higher, they don't just reflect optimism. They raise the stakes. More people step in expecting continuation. More leverage enters quietly. The system becomes less forgiving. This is why some analysts who are bullish long-term still warn about consolidation. They're not contradicting themselves. They're respecting silver's mechanics. Another key detail is mining supply. Silver production has not surged to meet demand. Most silver comes as a byproduct of other metals. That limits responsiveness. Even at higher prices, new supply takes years to materialize. That's supportive long-term. But again, it does nothing to smooth price action today. This is why silver behaves like a pressure system. Demand pushes from one side, supply resists from the other. Positioning amplifies everything in between. When pressure builds gradually, silver trends. When pressure builds quickly, silver snaps. The forecasts for 2026 are built on structural arguments. Those arguments are valid. What they don't capture is how silver behaves when too many people believe them at once. That's the risk phase. This is also why comparisons to earlier cycles matter, even if the conditions are different. In past silver bull markets, the most painful drawdowns didn't happen at the beginning or the end, they happened in the middle, right after the market convinced people the move was real. That's where silver is now. Many analysts expect consolidation before the next major leg. That's not weakness, that's process. But consolidation in silver is rarely gentle. It often looks like confusion, false starts, sharp drops that feel unjustified. They aren't unjustified, they are clearing mechanisms. This is why forecasts should be read as ranges, not targets. A projection of $60, $70, or even $100 does not mean a straight path. It means a zone that could be reached under the right conditions. Between here and there, silver will test patience. This is where the warning must be clear. Silver's bull case is not invalidated by volatility, but volatility will punish anyone who treats forecasts as guarantees. That's the difference between understanding silver and believing in it. Belief doesn't protect capital. Structure does. And structure is what the market is testing now. By January 2026, the most important signal in silver is not price, it's disagreement. When respected institutions and public figures look at the same market and arrive at radically different conclusions, that tells you something important. It tells you the market is no longer anchored. Look closely at the range of silver price predictions now circulating. On the conservative end, the World Bank still sees silver around $40. That's barely above levels silver already left behind. JP Morgan moves higher into the high 50s. Saxo Bank and Citigroup cluster around 60 to 70. HSBC sits just under 70. Those numbers are not extreme. They assume continuation, not acceleration. Then the tone shifts. Independent research firms start talking about 75, then 88, not next month, but over the next couple of years. And then there's Robert Kiyosaki, $100 to $200 in 2026. That is not an incremental adjustment. That is a different narrative entirely. This spread is not accidental. It reflects two competing views of silver. One view sees silver as a commodity that is already repriced and now needs to consolidate. The other sees silver as a monetary asset on the edge of something much bigger. Both views can be internally consistent, but they create very different behaviors. This is where risk concentrates. When price targets cluster tightly, markets move methodically. When targets scatter this widely, markets become unstable. Why? Because participants are no longer aligned on time. Some are positioning for modest gains over 12 months, others are positioning for exponential moves in a matter of quarters. That mismatch creates friction. Friction creates volatility. This is where many investors misunderstand what these forecasts actually mean. They read them as probability rankings. Who is more likely to be right? That's the wrong question. The right question is what these forecasts do to positioning. When institutions publish moderate targets, they tend to attract slower capital. Pensions, allocators, risk-managed flows. When public figures publish extreme targets, they attract fast capital. Retail money, leverage, momentum chasing. Silver reacts differently to each. Slow capital stabilizes price. Fast capital destabilizes it. The problem in early 2026 is that both are arriving at the same time. That's rare. In 2025, silver was still climbing into recognition. In 2026, silver is being pulled in opposite directions. One group wants consolidation, another wants acceleration. Silver cannot satisfy both simultaneously. This is why the warning matters now. The presence of $100 to $200 forecasts does not automatically mean silver is about to explode higher. It means expectations have stretched beyond structure. That stretch is where damage happens. Think of silver like a rope under tension. Moderate forecasts pull gently, extreme forecasts yank hard. If the rope is strong enough, it holds. If not, it snaps back violently. That snapback is volatility. This is not a criticism of bullish views. It's a recognition of mechanics. Silver's market is small compared to gold. Liquidity is thinner. Reactions are faster. When aggressive expectations meet a market still digesting a historic rally, the result is instability. This is why even analysts who are bullish long-term still warn about consolidation phases. They're not contradicting the upside case. They're acknowledging silver's nature. Another important detail in the prediction range is timing. Most institutional forecasts target 2026. Some extend to 2027 or 2028. That tells you something else. Even the bullish professionals do not expect silver to move in a straight line. They expect time to be part of the process. The only forecasts that compress time aggressively are the most extreme ones. That compression is seductive and dangerous. It encourages people to ignore drawdowns, to add exposure at the wrong moments, to confuse belief with risk management. This is where silver punishes. Silver does not reward impatience after big years. It exposes it. This is also why the gap between $40 forecasts and $200 forecasts is not just about price, it's about philosophy. Is silver primarily an industrial metal with cyclical constraints, or is it a monetary asset on the verge of remonetization? The market hasn't decided yet, and markets that haven't decided swing harder. This undecided state is what makes silver risky in early 2026, not because one side is wrong, but because both sides are acting at once. This is why price action can feel chaotic. One day, silver trades like a commodity. The next day, it trades like a currency hedge. That dual identity has always existed. But after 2025's rally, it's more pronounced. This is also why relying on a single forecast is dangerous. Forecasts do not account for who else believes them. They do not account for crowding. They do not account for leverage. Silver reacts to those things immediately. This is where clarity must override excitement. The prediction range should not be read as a roadmap. It should be read as a stress map. It shows where expectations are building and where disappointment could hit hardest. The widest gaps are where volatility concentrates. Right now, that gap sits between moderate institutional targets and extreme public forecasts. That gap is the danger zone. This does not mean silver cannot reach high levels over time. It means the path will be uneven, and uneven paths punish those who assume smoothness. The rope is being pulled from both ends now. How long it holds depends on how many people pull at once and how hard they pull. That's the test silver faces in 2026, not whether it can rise, but whether it can rise without breaking those who believe in it most. By the time silver reaches this stage in a cycle, the most dangerous mistake is false certainty. Not pessimism, not optimism, certainty. That's what breaks people in volatile markets. As 2026 unfolds, silver is no longer proving its relevance. That debate is over. The question now is how silver behaves under pressure. And pressure is building from multiple directions at once. On one side, industrial demand continues to act like a slow, steady engine. Solar manufacturers don't pause because price is volatile. EV production doesn't slow because futures swing. Data centers don't wait for technical pullbacks. That demand is structural. It's persistent. On the other side, financial demand is reactive. It moves with headlines, expectations, and positioning. The combination is powerful. It is also unstable. This is why silver in 2026 is not a simple continuation story. It's a balance problem. Too little demand and price stagnates. Too much expectation and price snaps back. Silver sits between those extremes. This is where many people confuse bullish with safe. Silver can be bullish and still hurt you. That's not a contradiction. It's a warning. The market right now is not fragile because fundamentals are weak. It's fragile because participation has expanded faster than discipline. After a 147% year, silver attracted attention that didn't exist before. That attention doesn't leave quietly. Some participants are long-term holders. Some are momentum-driven. Some are highly leveraged. Silver does not differentiate emotionally. It differentiates mechanically. When pressure increases, it exposes weak positioning first. This is why early 2026 will likely continue to feel uncomfortable. Rallies may be sharp, pullbacks may be sudden, price may feel disconnected from headlines. That's not dysfunction. That's digestion. Markets that reprice violently need time to rebuild balance. Silver is doing that now. This is also why focusing on exact price targets can be misleading. A $100 silver price is possible under certain conditions. So is a long period of consolidation before that happens. Both can be true. What matters is not the destination alone, it's the path. And silver's path is rarely smooth when expectations run ahead of structure. This is where discipline becomes more valuable than conviction. Understanding silver's dual role matters more now than ever. It is not just an industrial input. It is not just a monetary hedge. It is both. That dual identity is what gives silver upside potential. It is also what amplifies volatility. When economic growth expectations rise, industrial demand supports price. When financial stress rises, monetary demand supports price. But when both forces act at once, silver doesn't glide. It jolts. That jolt is what many people underestimate. This is why some of the most experienced analysts emphasize flexibility over forecasts. They're not abandoning the bullish case. They're respecting silver's behavior. The biggest mistake in this phase is treating silver like gold. Gold absorbs stress. Silver reflects it. Gold smooths volatility. Silver magnifies it. That's not a flaw. That's its nature. As 2026 progresses, the most important signals won't come from predictions. They'll come from behavior. How does silver react to rate decisions? How does it move during geopolitical shocks? How does it respond when inventories tighten further? Those reactions matter more than any single forecast. Silver doesn't announce its next move in advance. It reveals it through stress. That's why this phase demands awareness, not excitement. Not because silver's story is ending, but because it's maturing. Markets punish those who arrive late and impatient. They reward those who understand the terrain. Silver's terrain in 2026 is uneven, pressurized, and fast-moving. That's the reality, not collapse, not guaranteed riches. Reality. Now let's address the questions people keep asking on social media platforms.